Silver was down massively yesterday, about 17% on the day, down to $72 per ounce. A lot of investors are worried that the price is being actively manipulated lower by the powers that be. While I would like to do a video addressing the claims of manipulation head-on, first we need the information in this video, where we explore where the volatility in silver actually comes from. Stick around. I saw this tweet yesterday, and I hope that if any of you saw it, you were not fooled by it. Another 12 sigma hour for silver. Negative 15% silver in an hour happens once every 7 trillion years. The nature of these fake paper slams guarantee that COMEX is failing in March. I don't know about that. I wouldn't bet on it. I also wouldn't bet against it. But this 7 trillion claim is obviously ridiculous. Someone named Jason who watched my latest video said, "Isn't that assuming a normal distribution?" And yes, you're absolutely right. Silver has fat tails. It is not a normal distribution. The probability of getting an outlier event is very high. You might see a claim of 1 in a trillion or 1 in 7 trillion, but it's probably way more common than that. The numbers bear that out. We also talked about how silver has two different pricing regimes. It has a normal regime where returns are kind of normal, and then it has volatile regimes. We are absolutely in a volatile regime right now. We are going to get big moves up and down that seem like a 1 in a million, 1 in a billion, 1 in a trillion type event. But we know that they're coming in both directions, and so we shouldn't be surprised by it. What we didn't talk about in the last video is why that is the case. Where does this volatility come from? That's the subject of this video. First, I want to invite you all to a live event that I am hosting next week over Zoom on Tuesday, February 10th from 12 to 1 p.m. Eastern. If you want to ask me any questions live over Zoom, now is your chance. You can register at goldsilver.com/askAlin. Now let's get into the 6 primary causes of silver's volatility. The first and most important one is a small, thinly traded investment float. The silver market is smaller than gold. If we look at the above-ground supply of both metals, we see that there's far more silver. Anything that's non-responsive to price, silver that's in your cell phone, in your car, in a solar panel, or in jewelry, isn't going to respond to price as immediately as investment-grade bullion. Gold and silver have about the same float in ounces, but it's not the number of ounces that matters. It's the dollar value that it can absorb. When we multiply those ounces by today's price, the investable float for gold is far greater than that of silver, roughly whatever the gold-silver ratio is. Right now, it's about 65 times larger. That means dollar for dollar, gold can absorb more dollars without moving the price. If you put the same dollar value into silver, you're going to move the price more dramatically. Silver has far less capital that can absorb flows, and large orders move the price more quickly. If you only remember one factor, let it be this one. This is the most important one. Number 2, byproduct supply equals a rigid supply. Silver is primarily mined as a byproduct of other mines. Copper, zinc, nickel, even gold. About 2/3 of silver is mined as a byproduct of other mines. Most silver is not from a dedicated silver mine. Silver production doesn't respond to silver prices. Even as the price of silver goes up, you don't just turn on more silver mines and suddenly have more silver to meet demand. It has to come from other metals, and that takes a longer time. Supply can't smooth price shocks, so they stay volatile. The best cure for high prices is high prices, except in silver. Number 3, industrial demand is price inelastic. Most of the silver that is mined is used in industry, not as money or as an investment. Manufacturers buy silver based on its utility, not its price. If you're going to make a solar panel or a smartphone, you need that silver based on its utility. If the price of silver doubles or triples, you pretty much have to buy it no matter what. Silver is such a small percentage of the ingredients in any particular product that it's not going to affect the price of the product too much. Manufacturers hedge prices to make sure they're not paying too much or selling their silver product for too little. That creates a short flow during uncertainty. Sometimes there's selling pressure even though no one's bearish on the price of silver. All of these factors combined create price volatility coming from industrial demand. Number 4, heavy use of leverage. Futures, not physical, dominate price discovery. The marginal price of silver yesterday, today, and tomorrow is going to be determined by futures prices, not physical flows. Leverage amplifies both upside and downside moves. So many market participants, the majority of them, are using leverage in the futures market. When the price of silver goes up a little, it actually goes up a lot. When it goes down a little, it goes down a lot. We get an amplification effect. There's already volatility from the factors we've mentioned, and this volatility creates more volatility. It's also tougher to arbitrage silver than gold because of lower value density. $1 million of gold is fairly compact because it's so value dense, but $1 million of silver is quite bulky, heavier to transport, and more expensive. Therefore, it's more difficult to arbitrage. When we get price separations, bits of volatility in the silver market, they persist even longer because it's harder to arbitrage them away. Paper products are abundant relative to physical. In a market that's heavily dominated by futures or paper, it's very easy to create new paper products and use that to manage your price exposure. It's much harder to get the physical element in your hands. That in itself is not nefarious. It's just a feature of the market. Number 5. Stop losses and margin mechanics. Volatility triggers forced selling. If the price moves high or low to a certain level, certain participants are going to have to sell in order to maintain margin requirements or to manage their risk. When the CME raises margin requirements, investors have to put up more dollars to cover that percentage or sell some of their silver so that their position isn't so extended. Margin increases increase the amount of forced selling that happens, and then we get a cascading snowball effect. This is an example of volatility creating more volatility. All that selling causes more volatility. We get a positive feedback loop. This dynamic works both ways. It causes big ups that get even bigger, and it causes big downs that seem to fall through air pockets where there's no bottom in sight. Number 6. Silver is both metal and money. Sometimes silver trades like gold, and other times it trades like copper. It has two different trading regimes. Anytime you have two different trading regimes, you're bouncing back and forth between them. That's volatility. Silver is a perfect example. Silver also attracts speculators who find gold too slow or too capital intensive. Gold is much slower to reprice. Silver moves a lot more quickly. A lot of people want to get rich quick. They don't want to get rich slowly. Silver is very attractive for those people. Silver reprices violently during macro regime shifts, and part of that is because it's so small and thinly traded. Part of it is the other factors we mentioned here. Those are the 6 factors creating so much of the volatility in the silver market. Now that we understand that, we can explore the topic of manipulation in an upcoming video. I've got silver, the fastest horse in town. Now help me catch him. Thanks for watching.